Let's get to the latest on trade. We have stocks are whipsawing amid President Trump's latest comments on the U.S. China trade war, saying that the U.S. is, quote, not ready to make a deal yesterday. Now, this coming as J.P. Morgan Chase CEO Jamie Dimon also weighed in on the tensions between the world's two largest economies. Now, saying at a conference earlier that, quote, I think trade is a real issue. Trade has gone from being a skirmish to being a far more important than that. If this goes south in a bad way and you have other surprises, that could be part of the thing that changes confidence, changes people willing to invest. Joining me now is Malley, Tabak Managing Director. We also have Jordan Stuart, Federated Investors Client Portfolio Manager. Thank you both for being here. Jordan, let me just start with you, get your thoughts on what Jamie Dimon was saying just in terms of the trade war and its implications here in terms of people wanting to invest. What do you think?
Sure. This has been a long time coming. I think global industrial companies have looked to decentralize their manufacturing base outside of China for some time. And now I think the trade war is more of an excuse to accelerate that. But as I think about investors, Jamie Dimon's right. I think it's going to cause investors to hesitate in certain sectors, but also from our perspective, it's causing investors to focus on technology, healthcare companies. That you meet with these CEOs and you talk to them, you say, what inning are we in the economic cycle? What do you think about the China tariff? They don't really care. They're focused on developing technologies that are changing the way we live, curing diseases in biotechnology, and I think that's going to continue as these trade wars continue to dominate the headlines and indiscriminately sell off some of these other names that really have no exposure there.
Matt, what is your reaction to what's been going on? Because in your recent comments, you said that you think that we'll see another or new lower lows here before long, just in terms of the fact that you think that the broader markets could take another leg lower. What do you think will prompt that, and how big of a sell-off could we see in the future?
Well, it's just what we had even before the negotiations broke down and the trade talks. The market was just getting extended. We saw valuations getting high, not crazy high levels, but they were getting high. The market was getting overbought. And you saw some certain groups like the semiconductors were starting to slightly roll over a little bit. So it was getting ripe for a pullback anyway. But, you had a lot of old sayings on Wall Street, some are good or some are not so good. But one that is very good is that when the facts change, we need to change our opinions. And I think that what the facts did change. It was priced in that we were going to get this trade negotiations and trade deals signed, whether it be May or no later than June. Now it's kind of open-ended. We don't know when it's going to happen. And therefore, the market needs to reprice a little bit. I was thinking we'd get a 3 to 5% correction when this new news came out, when a change in the facts took place. I think it has to be a deeper correction, more down near 10%. I'm certainly not saying we're going to get a repeat of what we saw in the fourth quarter of last year, but we do. I just think we were expecting much better growth in the second half, a nice rebound in earnings, especially in the fourth quarter. It looks like we might not get the same kind of bounce back, so we need to reprice for that reality.
Jordan, this is just high stakes poker, you can almost call it. You're talking about Matt just saying that the near-term resolution doesn't seem that feasible at this point or that likely. When do you think we'll see some sort of resolution on the trade front?
I don't know. Look, again, this is more than just one president. This has been a process. I think you have the two largest economies in the world battling over trade negotiations, and it's going to take some time. But just like Matt said, if there are sell-offs coming, they're going to be indiscriminate. It's going to be macro, tweet-induced sometimes, which is going to create opportunities. And Matt suggested that that you could see earnings start to accelerate, and I think earnings are going to come from, like the sectors I mentioned before, from the tech, especially software, biotech companies that are producing earnings regardless of kind of this macro backdrop that could be negative in the short term.
Matt, do you see any investment opportunity in some of these tech giants? A lot of them have been hit pretty hard. We were just discussing in the last segment the fact that Citi's saying that, hey, iPhone sales could be slashed in half because of this trade war. Is there any opportunity here to buy some of these big tech names that do have some exposure over to China that have been beaten down?
Well, I think it's a little early yet, but again, one of the greatest things right now is, and we learned this in the fourth quarter of last year, and when we had a lot of uncertainty last summer and early last fall, I was talking about this, and I think people should be doing the same thing. If you raise a little bit of cash here, it's not saying suddenly go to 25% cash or anything. You raise a little cash, get a little bit more defensive, but then you can take advantage of the opportunities when they do throw the baby out with the bathwater. And we get some of these companies, like you say, are either not going to be hurt by the trade war as much as others, or number one, or number two, have great exposure, great cash levels, and things like that. the key is to get those get a plan in place in advance, so you know which stocks and what kind of levels you would like to buy them at, so that you don't panic if the market just drops 10%. People are going to start to get very worried, start to panic, and of course with these algorithms and things like that, the market tends to overshoot to one degree or another. But if you've got that plan in place, and you got a little bit of cash on the sidelines, you can take advantage of those dips and buy some of those names. But I think it's going to be, and the market's going to be more down 8 to 10% before that really happens.
Hey, Jordan, I mean, just in terms, there was a new Deutsche Bank note out today just revealing that an increase in the tariffs could cut jobs in auto sector and industrial goods, also in the retail sectors. What do you see as a potential economic impact here?
Look, I think longer-term investment capital is going to come back to the United States, into Europe, as you see more of a regionalized capacity rebuild outside of China. But in the near term, sure, yeah, I agree with Matt that there's going to be opportunities, and you want to avoid some of those sectors. And frankly, I think what he's saying is active management's going to work again, where we're going to be able to avoid and find opportunities that we think won't be impacted or impacted less. And those stocks are going to work. Other stocks might get hit. We'll see what happens. We'll see what transpires.
All right, well, Jordan Stuart and Matt Malley, thank you so much for joining me today.